Good morning.
Good morning, sir.
Good
Good
morning.
morning, sir. Can you hear me?
Yeah, good morning. Yes, sorry, the class is starting a bit late today. It was due to circumstances beyond my control. So last week we started with, if we could collect, we started with capital allowance. And last week I was able to give us the basic requirements, the different requirements, what we are supposed to know as far as capital allowance is concerned. I told us about the types of capital allowance, which I told us we have various types, which we have initial allowance, we have annual allowance, investment allowance. Then so when there is disposal, that can also give rise to a balancing charge and balancing allowance. So all those are what are treated last week. So today we'll be looking at the computation aspect. The computation aspect, so how to compute the capital allowance itself, which is very, very important. So I'm coming. So let me look for our working load. So the computation aspect is what we'll be looking at today. So we are going to start with the first question we have here. Question number one. Question one. So we have the question of Dorothy Endow, Nigeria Limited is a company engaged in manufacture of plastic products. Due to company dwindling fortune, the company's board of directors decided to cease business on 31st March 2024. The accessible profit of the company for the relevant year as follows. So we have for year ended 30 June 2021, 22, 23, and up to the date of cessation. All figures are provided. Then the company acquired the following fixed assets in recent time: land, foundation for factory building, factory construction, motor vehicle, fairly used. 2, then tax written down value brought forward in respect of plant and machinery for 2022 assessment year was 720,000. The plant and machinery were installed and commissioned on 4 April 2019. On cessation of business, the fixed assets were disposed of as follows. So as at the date of cessation, they also disposed of some of the fixed assets. So required, compute the capital allowance for all relevant years of assessment. As we already know, I told us earlier that as far as capital allowance is concerned, for you to be able to compute capital allowance, you need your knowledge of accessible profit. So we need a good and sound knowledge of accessible profit to be able to compute what? To be able to compute capital allowance. So for us to be able to compute this capital, we first of all need to get what? Our computation of what? Of tax liability, of computation of accessible profit, which is what? The basis period. So, then this question also relates to cessation of trade. So that means we are going to apply the principle of cessation to this particular scenario. So the principle of cessation will be adopted on what? On this one, on this analysis. So we have the question, we have the name of the taxpayer as Dorothy Endow, Nigeria Limited. We have the name of the taxpayer, Dorothy Endowed. As we all know, Nigeria Limited. As we all know, the requirement is very important. as far as taxation is concerned. Then we have computation of capital allowance for relevant year of assessment. So before we can compute this capital allowance, we first of all need to carry out our workings. So workings, we have working one. So computation, determination of basis period and assets allocation. So we need to determine our basis period and also to allocate the various assets that were acquired to various years of assessment. So according to this question, the first information given to us relate to year ended 30 June 2021. If you have a question relating to, so before that, so let me analyze the various information given to us so that we'll be able to, so I want to look at some information as well, which we are also going to need for our computation. We have one, accounting date. So the accounting date of this particular taxpayer is as at what? 30th June, 36 annually. Then we are giving, so date of cessation to be equals to, so from the question, we are told that the company ceased operation on 31st March 2024. Date of cessation to be 31/3/2024. So I need these two information first. So from this information now, so this is working 3. I can now, so if I have an accounting date that is ending, let me put, if I have an accounting date that is ending on, look at it, accounting date that is ending on 30, accounting date ending on 30 June 2021. Who can tell me what is going to be the year of assessment for an accounting date ending on 30 June 2021? What will be the year of assessment? Yeah, 2022. That is on what? On preceding year basis. So that means based on this information, the first year we are going to consider, according to this information, will be what? 2022 year of assessment. So the first year will be 2022. The first year will be 2022. Then we have tax year. Okay. So we have tax year. We have basis period. Basis period. So we need those information. So for 2022 year of assessment, the basis period will be from 1/7/2019 to 36/2020. Okay, 2020. Okay, this will be 2020 to 36/2021 on preceding year basis. Then also we also have for 2023. 2023 will be 1/7/2021 to 36/2022, in line with the accounting date. Then in 2024 year of assessment, what happened in 2024 year of assessment? Who can tell us? What happened to the company?
Cessation took place.
And whenever there is cessation, what do we normally do? We normally add either 6 months or 3 months to what? To the date of cessation. to what? In order to determine what? The year of assessment. So how many months are we going to add to this date of cessation here?
6
How
months.
many months? 6 months, because this taxpayer is what?
It's a
Is a
company.
corporate, yeah, it's a corporate taxpayer. When you add 6 months to 31/3/2024, which year is it going to give us? What date is it going to give us? I want to add 6 months to 31 March 2024. What date do I have?
That would be
It will be 30th
September.
September
September.
2024.
Still what? Still
Maybe
2024. Still the same year. So what I want to look at is what that same year. It's still within the same year. So because I'm doing capital allowance, I want to combine all the basis period together because of what? Because of asset allocation. So we have a 1/7/2022 to the date of cessation, which is what? 31/3/2024. I did this because I'm doing capital. On a normal day, I'm supposed to do firstly the one for date of for preceding year, and also do the last one for 2024. But because this relates to capital allowance, so we combine all the dates together to the date of cessation. Then after that, I now need to allocate my asset allocation. So for asset allocation, so you now go back to the question and look at when the assets were acquired. What date were the assets acquired? So the first thing, the company acquired the following fixed asset in recent time. We have a land, 15/12/2020 land. Please, for land, there is no capital allowance is not applicable to land. Because what? Land does not depreciate. Land appreciates in nature. So capital allowance is not applicable to land. You are going to have capital allowance on land when you have the information combined together, when you have land and building. Assuming they give us land and building together, yes, it will be available for capital allowance claim. But where it is stated separately, please, land does not is not available for capital allowance claim when it is stated separately, because land does not depreciate. Land appreciates in nature. So in that case, so land, we have a 15/12/2020 land. So no capital allowance will be computed on that. But then after that, we have a 37/2021 foundation of factory building. So what I need here is what? Is this date. I want to look at this date, 37/2021. So you now go back to, let's go back to our Z sheet, 37/2021. So you now come to this, your basis period. In which date can we find 37/2021? Who can tell us? Out of these 3 dates, which of the year can we find 37/2021? Which year can we find that date? 37/2021. Which of 2023? If you look at this 2023, we can find that date here. So that means that asset will be allocated to this year of assessment. We have it as well. Factory building. Factory building. How much is the asset? 700,000. So 700,000 naira as well for factory. 700,000 naira. So after that, I also have, if you look at the next asset that we acquire, we have what? 18/8/2021, factory construction. 18/8/2021, factory construction. We have it as what? 1.2 million. You also go back to that information. Where can we find 18/8/2021? Where can we find, which year can we find 18/8/2021?
2023.
The same 2023. We have it as well. Factory construction. You also allocate that here. You're also going to allocate that asset to, which is what? 1.2 million. 1,200,000 naira. Then after that, the next category of asset we have is what? 16/12/2021, motor vehicle, fairly used, 800,000. So you also go to that date. When can we find 16/12/2021? Which year can we find 16/12/2021? Which year?
16/12.
16/12/2021. Which year can we find that?
2023.
Also 2023. So we have a motor vehicle. I also have motor vehicle. So we are told that what the motor vehicle are two items. So two. We have how much? 800,000. So will be available for what? For capital allowance claim. So all these assets will be available for what? For capital allowance claim. So since you have known where to allocate your assets, so the next thing for you is now what? You can now compute your capital allowance. Then for the computation of the capital allowance, please, the asset will be listed. The asset will be listed in columnar form. Based on the number of assets that were available, we are going to list them in column. So for this now, I have what? Under this information, I have factory building, factory construction. These are the same category of assets. They are both factory. They will be entitled to what? To the same percentage of capital allowance. So you can what? Combine them together since what they occur in the same year. So for that, we have what? The first category of asset. We have factory building. Factory building. Also, after factory building, I also have what? Motor vehicle. We also have another asset, motor vehicle. That is also another category of asset, motor vehicle. That will also be stated in column. Then, if you look at the question, the question made mention of what? Another category of asset. Let me go back to the question. Tax written down value brought forward in respect of plant and machinery. That means we also have what? Plant and machinery. So we have a three category of assets as far as what this particular company is concerned. So we have a plant and machinery. So the resulting, so after that, we now have what? Total column. For of these assets, they are entitled, they have what is called what? Initial allowance. We have annual allowance. We also have what? Investment allowance. Please, for the rate of the capital allowance, you don't need to stress yourself. I have already stated this particular information earlier also that this rate will be given to you by the examiner. Just go to the back of the question paper. You are going to find this rate for each category of asset at the back of your question paper. Your own is just to pick what the appropriate rate, that is what? That relates to what? To each category of asset. The examiner will give you this rate. But for the purpose of this class, so if you look at the material on capital allowance, so you are going to find the rate in the material on page 4. So these are the rates. So this table will be provided to you by the examiner. The examiner will give you this table relating to what? To that. Alimat, mute your mic, please. Mute your mic. So this table will be given to you by the examiner for each of these rates. So the first thing I need is a factory building. Factory building. So that's it. If you look at this table now, that is what we have: a building expenditure. We also have industrial building expenditure. So factory building, that is what industrial building expenditure. Initial allowance is 15%. Annual allowance is 10%. So you now go to your solution. Then you are going to what? You are going to state out those rates. We have what? each of the rate forward for each of what? Each of the, so we have a factory building. So initial allowance 15%, annual allowance 10%. So you state them out. Initial allowance 15%, annual allowance 10%. So this rate will be given to you by the examiner. If you also go back to the material, you also see motor vehicle. We have what? From the material, we have motor vehicle 50, 25. So we have it as 50% and 25%. Then we also have plant and machinery. From the material, you also see what? Plant expenditure, excluding furniture and 50, which is what? 50, 25. So we have what? 50%. We also have 50 and what? 25%. Then also for plants, plant and machinery, investment allowance of 10% is also applicable to plants and machinery. So those are the various respective allowance that are available at the various rates. So those are the rates for each of what? For each of what? Each of these assets. So after knowing the rate, so the next thing for you is to know. So we are giving information related to 2022. So that is based on information provided by the examiner. So you are going to, so we have a 2022 year of assessment. But in this 2022, no asset was acquired based on information provided. But from the question, let me go to the question. From the question, we are told that from the question told us that tax written down value, look at it, tax written down value brought forward in respect of plant and machinery for 2022 assessment year was 720,000. The plant and machinery were installed and commissioned on 4 April 2019. Tax written down value of this plant and machinery as at what? 2022 year of assessment was 720,000. So that amount, you are going to bring it in as well, tax written down value in this year of assessment. Tax written down value. So under our plant and machinery, which is what? How much? 720,000. 720,000. So that is what? That is the value for the plant and machinery. So this value now, because we are giving tax written down value, so that means some, and don't forget, I told you that tax written down value is calculated, tax written down value, working for, tax written down value is equal to cost minus initial allowance, minus annual allowance. So what this means is that for this asset, before this 2022 year of assessment, they will have, this asset, they have been claiming what? Capital allowance on this asset. So that means in the year it was acquired, they will have claimed what? Initial allowance. So the only allowance that will be available for claim, only in this year will be what? Annual allowance. We now need to what? To know how much annual allowance are we going to claim. So we have what? Annual allowance for what? For plant and machinery. Annual allowance for plant and machinery for 21 in 2022. So we are told from the question that this asset was installed, commissioned and installed on 4 April 2019. Installed, it was acquired on 4, installed on 4/4/2019. 4/4/2019. So the next thing for you is now to look at what basis period is this 4/4/2019 going to fall into, in line with what? The company accounting date. If you look at the accounting date of the company is what? June. And I need a basis period that is going to fall into what? Into, that this date is going to fall into. So who can tell us what will be? So that means the basis period that this date is going to fall into will be what? Look at it, will be 1, 7, 2018 to 30 is 2019, which will be forward for 2020 year of assessment. In line with what? In line with the accounting date of this company. If you look at this date of 4/4/2019, you can see that you can find this date 4/4/2019 in this basis period. That means this asset started claiming capital allowance from where? From 2020 year of assessment. Take note of that. This company start claiming capital allowance on this asset from 2020 year of assessment. And we are now in 2022 year of assessment. That means before this 2022, they will have claimed annual allowance for what? 2020 and what? 2021 year of assessment. That means they will have claimed annual allowance for how many years? 2 years, 2020 and 2021, before what? Before this 2022 year of assessment. So for us to now be able to calculate the annual allowance, that is so. And we know that annual allowance for subsequent year is calculated as tax written down value divided by big N minus small n. So in that case, we know that our tax written down value as at 2022 is 720,000. And big N for this year is big N. Look at it, is this plant and machinery is available for capital allowance claim for annual allowance for how many years? For 25%, which should be for how many years?
4 years.
4 years. That will be what? 100 divided by 4. Our big N is 4 years. Then why our small n is before 2022. How many years have we claimed the capital allowance? That is number of years for which you have claimed the capital allowance. How many years?
2 years.
2 years, which is what? 2021 and 2020.
2020 and 2021.
2020 and 2021. So 2 years. So you have claimed it for 2 years. So that means our annual allowance for this year will now be 720 divided by, so it will be 720 divided by big N 4 minus small n. So that will give us 720, 4 divided by 4, 4 minus 2. So that will give me 720. Okay. Who is that now? Mute your mic, 4 minus 2. So that will give me, so in that case, so that will give me 720 divided by what? Divided by 2, which will give us how much? Divided by 2. So the value will give us what? So that will give us equals to what? 360,000. So 360,000. So what that means is that your annual allowance in this year, annual allowance for this year will be 360,000 equals to what? 360,000. So annual allowance for this year will now be 360,000. So that will now be what? In brackets. So you are going to put it in brackets. So the total, under the total column, you transfer any capital allowance you calculate in that year to the total column. So that will be what? The annual allowance in that one, in that year of assessment, 360,000 naira. So the company did not acquire any assets in 2022. So that means that is the only asset that will come in 2022. So the next year, we now move to next year, 2023. So 2023 now, you also have a tax written down value. Your tax written down value will now be 220 minus 360,000. So that will give me 360,000. So that will give us 360,000. We have what? So in this 2023 now, the company acquire new assets. You now bring in those new assets. You have a cost as new asset as cost. The first asset we have is your factory building and factory construction. You are going, because they are the same category of assets that were acquired in the same year, you are going to add them together. 1.2 plus 700,000 will give us 1.9 million. So cost Cost under here, factory building will be 1,900,000 for factory building. We also have a motor vehicle was also acquired in 2023 year of assessment. Motor vehicle will be what? 800,000. So under motor vehicle, we have it as what? 800,000. For any new asset that is going to be available for what? Initial allowance. So you are going to calculate initial allowance, then working seat. Initial allowance. So initial allowance for factory building will be initial allowance for factory building will be to calculate initial allowance. Initial allowance is calculated as what? Cost multiplied by what? Initial allowance rate is what? How to calculate the initial allowance. So initial allowance for 2023 year of assessment for factory building will give us 1,900,000 multiplied by the capital initial allowance rate, which is what? 15%. So that will give us the value to 1,900,000 multiplied by 15%. Multiplied by 15%. So that will give us 285,000. 285,000. So 285,000. So you are going to put that in jacket. 285,000 as what? As the initial allowance. Also, for this asset, we are going to have annual allowance. Annual allowance in the first year of assessment is calculated as cost minus initial allowance over big N divided by number of years. So that will give us cost, which is what? 1.9 million minus initial allowance, we just calculate, which is what? 285,000 divided by N. How many years are they going to claim annual allowance for factory building? Who can tell us?
10 years.
10%. That will be 100 divided by 10. That will be what? 10. They are going to claim it for 10 years. So the value will be what? That will give us a value which is equal to, so that will be equal to what? Which is equal to 1.9 million minus 285 divided by 10. So that will give us 161,500. 161,500. So will be what? Will give us the value. So 161,500. So annual allowance here will be what? 161,500. So will be the value for the annual allowance. So the same thing, you also go to motor vehicle. Because motor vehicle was also acquired newly. We have what? Initial allowance. Initial allowance will be what? 50% of 800,000. Working 7. Motor vehicle. Motor vehicle initial allowance will be cost multiplied by initial allowance rate, which will be what? 50% multiplied by 800,000. So that will give us what? 400,000 naira. So will be what? So here we have a 400,000. 400,000. Then annual allowance will be equal to cost, which is 800,000 minus initial allowance 400,000 over number of years divided by how many years are they going to claim annual allowance for motor vehicle? We have 25%. How many years will that give us? 25%. How many years?
4 years.
25%. How many years?
4 years.
4 years. 4 years. So that will be what? Divided by 4. So we give us what? 4 years. So divided by 4. So that will give us the value for the annual allowance, which is what? 400,000 divided by 4. That will give us what? 100,000. That's what? As the value for what? For the annual allowance. So 100,000. So we also do the same thing here. Annual allowance, 100,000. 100,000. The addition of this, so for this now, we are going to have Cost, no plant and machinery was acquired in 2023. We have a dash there. Then we are going to have 0, 0. Let me put 0 there so that. Then for year, initial allowance, no asset was acquired. We also have a dash. Then both in 2023, so annual allowance, we have what? Annual allowance in 2023. This asset, we have what? A tax written down value of what? 360,000. And if you look at in 2023, this asset, they start claiming capital allowance from 2020 year of assessment. We have a 2021, 2022, 2020, 2020, 2021, 2022, and 2023. 2023 happened to be what, the 4th year. And we are set to claim the annual allowance for what? For 4 years. So that means the annual allowance will be what? 360 divided by what? 4 minus 4. 360 divided by 1. That will also give us 360,000. But I told you that at the end of the useful life, how much are we supposed to retain as the value of the asset at the end of the useful life of an asset? 10 naira. So, because this is the end of the useful life, 2023, you are going to retain 10 naira. So, annual allowance. So, the annual allowance in 2023, in the year 2023, for plant and machinery will now be equal to 360,000 minus 10 naira. So the value to be retained. So that will now give us the value, which is what? 360,000 minus 10. So that will give us 359,990. 359,990. So this value now will be brought here as what? 359 in jacket, 359,990 in jacket. So that will be the annual allowance. For each of the capital allowance, you are going to add them together. This will be 400 plus 285. So that will give us 685, 685,000. This will, the total will be transferred here. So we also add the total of this. So the total of that will give us addition of the three amounts will give us 621,490. 621. So 621,490. So this one now, you now get what? So you now use that to get what? Total capital allowance. So total capital allowance in that year, in year 2023, will give us what? Addition of what? Of these two capital allowance. Will give us what? Total capital allowance. So which we are going to what? We are going to close. After that, we now go to next year, which is your 2024 year of assessment. In 2024, you have a tax written down value. So tax written down value will now be this minus this minus this, which is what? Addition of what? Of this what? Of all this will give us 1,453,500. Also, addition of this will give us what? 1,453,500. So this one will be what? 360 minus 359,990. That will give us what? 10 naira. So we're going to be left with what? A value of what? 10 naira. In 2024, no asset was acquired. But in that 2024, there is disposal of asset and there is also what? Cessation. And I told you, any year that there is disposal of asset, capital allowance will not be available in that year. But this year that there is disposal, there is what? The company is having what? There is what we call what? There is disposal and there is what we call what? Sales proceed. They are selling the assets off. So there is what? Sales proceed. So the sales proceed of each of the assets will now be compared with what? With the, so we have what? Sales proceed. So let me go back to the question. From the question, I have what? Sales proceed. So on cessation of business, the fixed assets were disposed of as follows. Plant and machinery 585, factory building 2250, factory land 15, motor vehicle. So this sales proceed now. We are going to compare it with what? With the tax written down value as at the date of cessation. So sales proceed. For factory building, the first thing we have is what? Factory building. So sales proceed from factory building is what? 2250. So we have a 2250,000. Then sales proceed for motor vehicle happen to be what? 200,000. 200,000 naira. And sales proceed for plant and machinery was given as what? 585,000. So we have it as what? 585,000. So this sales proceed now, you now use it to get your balancing charge or balancing allowance. So now to my question, if our sales proceed is more than the tax written down value, what do we have? When sales proceed is more than the tax written down value, what do we have?
Balancing charge.
Balancing charge, which is what? Which is an income. So yeah, now we have a balancing charge, which is what the difference between, which is equals to this minus this. Then this one, when your tax written down value is more than your sales proceed, what do we have? When tax written down value is more than sales proceed, what do we have?
Balancing allowance.
Balancing allowance. Thank you. So we have a balancing allowance. So this one will be what? 100,000. Balancing allowance. So when your sales proceed is more than your tax written down value, you have what? When your tax written down value is more than your sales proceed, you have balancing allowance. Also, yeah. So this one will be 0, 0. So nothing here. So this one also will be what? 0, 0. Then also, yeah, our sales proceed is more than our tax written down value, which is what? 585,000 minus 10. So that will be what? 584,990. So we have it as a balancing charge. 584,990 as well as the balancing charge. This one will be 0, 0. So then I also told you that what? Balancing charge is what? Is usually restricted to what? What amount? Who can remind us? What amount do we restrict? No. Balancing charge is not to third. It is capital allowance that is restricted to third. The balancing charge to be charged to profit will be restricted to what?
30%.
Will be restricted to what? To the total capital allowance already claimed on the assets. You cannot what the tax law is looking at it is only the portion that you use in doing business that will be subject to what? Either company income tax or personal income tax. Any portion that is not utilized for the purpose of the business will be regarded as a chargeable gain, which will be liable to what? To capital gain tax at the rate of what? 10%. So this balancing charge will now be restricted to what? Total capital allowance. So how do we get the total capital allowance? In the case of the first one, we have balancing charge here. In the case of the first one, it will be what? The cost minus the tax written down value. Cost minus the tax written down value, which is what? 1.9 million minus 1,453,500. So that will give us, so cost minus which will give us the value for what? For the balancing. So for the total capital allowance charge on what? On the asset, which is what? So this balancing charge will now be restricted to what? 446,500. So any balance will now be regarded as what? Chargeable gain. Any balance between this 796,500 and this 446,500, which should be what? Minus 796,500, which should be what? 350,000. So 350,000 will be regarded as what? As a chargeable gain. So that will be subject to what? To capital gain tax. So that principle is not applicable to what? To balancing allowance. So it's not going to be applicable here. So for balancing allowance, nothing like restriction of what? To total capital allowance. Then also we also have balancing charge here of 584,990. We are not giving the cost of this particular asset, but we can get the total capital allowance already claimed. So from 2020, they have been claiming 360,000. If you multiply 360 times 4 minus 10, the value will give us 1,430,000. We don't know the value of the annual allowance because we are not giving. the value of what? The initial allowance, because we are not giving what the cost of the asset. But if you look at the value we have a 1,430,000. It's even more than what? The balancing charge that we want to charge to what? To our what? To our accessible profit. As a result of that, this one will not be what? Restricted. Amount to be restricted will not be what? Nil. So amount to be restricted here will be what? Nil. So also here we also be what? We also be nil. Why? Because by the time we calculated the total capital allowance already claimed on what? On this plant and machinery, the total that has been claimed is already above this amount of what? 584,990. So that is why what? That will not be restricted. It is only when what? When the capital allowance that you have claimed is not what? Is not up to what? Up to the balancing charge, that it will be restricted to what? To the amount of what? Of the total capital allowance claimed on the assets. So that is how to what? To calculate what? Capital allowance when you have what? A scenario of what? Cessation of what? Of trade or business. So any question?
Sorry, sir, I don't understand where you got this and 64,500 from.
Where we got how much?
The restricted,
64,000.
yes, the figure.
Okay. Yeah, okay. 446,500, Abby.
Yes.
Allowance claim, which will be, how do you get that? It is either you add these two information together, this initial allowance, because on this asset, factory building, we have only claimed only this initial allowance and annual allowance. These are the two categories of asset, capital allowance that we have only claimed. It is either you add these two information together, or you say cost, the cost minus tax written down value will give you the value. I always advise you, it is not advisable to be adding it together, because it will be easier for you if you have only 1 year like this. But if you have more than 1 year, to add them together will be difficulty. What you just do is to look at your cost minus the final tax written down value. We give you what? The total what? Total capital allowance already claimed on the asset, which is where we got what? This 446,504 from. Any other question?
Sir, please, how did we get the big N and small N?
Okay, the big N and small n. The N is related to what? How the number of big N is what? Number of years to claim the capital allowance. Why the small n is what? Number of years for which capital allowance has already been claimed. Big N is number of years to claim capital allowance. If you look at it from here, so let me look at the rate of the capital of the annual allowance from here is what? Is 10%. Sorry, okay, for plant and machinery. The rate of annual allowance is 25%. That means I'm supposed to be claiming 25% every year. And I'm going to claim 100%. If I'm going to be claiming 25% every year, how many years is it going to take me to claim what? 100%. So that will be what? 100 divided by 25. So that is how we got to this one, these 4 years. 100 divided by 25. 100 divided by 25. Why for the small n? Small n is a number of years for which capital allowance has already been claimed. Before this 2022 year of assessment, this asset, plant and machinery, has been in existence since 2020. So that means they will have claimed capital allowance for 2020 and 2021. So which is what? 2 years. That is where we got what the small n from. I hope that settles your question.
Yes, sir. Yes, sir.
Any other question?
Sir, how do we have that 10 to deduct from the plant and machinery? I don't really get that 10 naira.
10. Okay. It's not, we didn't get it. According to the tax law, it is recommended by law. You are supposed to retain a value of 10 naira as the nominal value of the asset. That is where so that 10 naira is what is recommended by law for all category of assets. It's not that we get it. It is what the law says that you should retain 10 naira. Because that asset must have a value by the time you want to sell it. That is why they expect you to retain 10 naira. Is it clear?
At the end of
At
4
the end
years
of the
or
useful life.
useful.
At the end of the useful life of the asset.
Okay, sir.
It is at the end of the useful life that you are going to retain that one. That value of what? Of 10 naira. At the end of the useful life of the asset. So that is for what? For that. So then we also have, then after that we have what? Then the next one we are looking at is what? Is if what happened when the asset is acquired on hire purchase? When you acquire asset on hire purchase, there is also what? A provision that because you are not going to pay for that asset at once, you are going to pay it on instrumental basis, which will be spread over various years. The government is also telling you that they are not going to grant you the capital allowance at once. Because you are not going to claim you are not going to make the payment once. Capital allowance claim will also not be what? Not be available at once when the asset is acquired on what? On hire purchase. So what is the provision of the law in relation to hire purchase? Then the law is that hire purchase, before that we need to know what hire purchase means. Hire purchase is an agreement between what? Between a buyer and a seller, which is usually called what? IRA and IRE. It's an agreement between a buyer and the seller, whereby the seller transfer the possession of the property to what? To the buyer. Over what? For the payment of what? Or for payment of a certain instrumental, which will be paid on what? On certain installment. After what? After the payment of what? Of the initial deposit. So it's an agreement that exists between what? Between a seller and a buyer, whereby the seller agrees that okay, the buyer is going to what? Is going to take possession of what? Of this asset without paying in full. But you are going to be paying me bit by bit. That is what hire purchase is all about. And because you are going to be paying bit by bit, if you now use that asset for the purpose of business, the tax law is also telling you that they are also going to grant you what? Grant you the capital allowance on what? On instrumental basis. So that is what the rule under what? Hire purchase. Then for this hire purchase, there are some terms that you need to be familiarize yourself with. We have what? IRR. IRR, that is the name of the seller. That is the seller of that one, of that particular phase asset. Is the owner of the asset, so that is selling it. Then we have what? The IRE, that is the buyer. The person who is buying that asset on what? Hire purchase. Then we have a cash price. So that is the price that you are assuming you are not buying the asset on hire purchase. How much, if I want to go to the market to go and buy the asset, how much will it cost me to acquire that asset? That is the cash price, the cost of buying the asset on what? On cash and carry. Then we have what? Higher purchase price. Because I'm postponing payment. Yeah, the owner of the asset is also going to add some interest to that particular asset. That interest, inclusive of the cash price, is what is called higher purchase price. So higher purchase price, that is the price you are paying for what? For buying what? For buying the asset. So the price you are paying for buying the asset, which is made up of what? Both the cash price and what? And the higher purchase interest. Then we have what? Instrumental payment. So those are the series of payments that will be paid by what? By the IRR for what? For the purpose of what? Series of payments that will be paid by the IRE for the purpose of what? For the purpose of gaining what? Possession of what? on hire purchase. So that is called instrumental payment. Then for hire purchase agreement, you need to get what? Your hire purchase price, where you are not giving. You may have a situation whereby you may not be giving the hire purchase price. And to determine the hire purchase price is what? The price they are selling it at the market, which is what? The cash price, plus the interest added by what? By the seller, plus the interest added by what? By the IRR. So hire purchase price is the addition of what? Of the cash price plus the hire purchase interest. Then we have what? Hire purchase price will be what? The addition of cash price plus hire purchase interest. Or you can also determine the hire purchase price by looking at what? The initial deposit plus what? Your total installment. Because as at the time you want to acquire that asset on hire purchase, the seller will not just give you the assets like that. The seller is going to ask you to what? To pay a certain amount of money as commitment fee. That money you paid is what is called initial deposit. So the addition of the initial deposit plus what? The addition of all the installments you are going to pay is called what? We also give us a hire purchase price. So hire purchase price can be what? Can be arrived at in two forms. So the hire purchase price can be arrived at in two forms. Hire purchase price can be HPP, hire purchase price, can be equals to addition of cash price. When you add your cash price plus hire purchase interest, hire purchase interest. The addition of this will give us what? The hire purchase price. But when we don't know this, if we don't know this, we can also get, or our hire purchase price can also be determined as our initial deposits, can also be determined as initial deposit plus total installments. So when you don't know the hire purchase price, so you can also get your where you don't know the hire purchase interest, you can also get the hire purchase price through what? The addition of initial deposit plus what? Plus the total installment. We also give us the hire purchase price. Either way can be used to what? To determine the hire purchase price. So when you know the hire purchase price, we can use it to what? To determine what? Instrumental amount that will be paid at each installment. Amount to be paid at each installment. Amount per installment. So we need to determine amount per installment. How do we determine the amount per installment? We have our hire purchase price, which we know already, hire purchase price. You now less your cash price, less cash price. Less the cash price. You know, when you remove hire purchase, we told you that hire purchase price is what? Is cash price plus interest. That means if you remove interest from hire purchase price, so that will give me, if you remove cash price from hire purchase price, that will give me what? The hire purchase interest, which is your hire purchase interest. So the hire purchase, so when you know the hire purchase interest, you can know what? Amount per what? Per installment for interest. So this amount per installment for interest will now be determined as what? Amount, then amount, instrumental payment, interest, instrumental payment will now be equals to total hire purchase interest, which we arrive at earlier, divided by number of installments. That is, we need to look at how many times are we going to pay this installment and how much is the interest that is included in each one, in each installment. We give us what? Amount per what? Per each installment, which is what? Total hire purchase interest divided by number of installment. We give us what? Interest per installment. The reason why we need to know interest per installment is because this interest is not going to be, is not available for what? Capital allowance claim. Why? Because interest is what? Is an allowable expenses when you are what? When you are computing your what? Your computation of tax liability. So that means if interest is going to be allowed for you for computation of tax liability, you are not going to be what? You are not going to be given the avenue to what? To also claim that interest again for the purpose of capital allowance. If you are going to claim it as allowable expenses and you also claim it again for the purpose of capital, that will become a double claim. So in order to avoid double claim, because the interest has already been allowed as an allowable expenses, it's not going to be available for capital allowance claim. As a result of that, you need to eliminate the any interest element that is included in what? In the hire purchase price. So what are now the procedure for what? For calculating capital allowance when what? When an asset is acquired on hire purchase. Then the first step to identify and calculate what? The hire purchase price. You first of all get your hire purchase price. Then determine the cost price of the asset, which is what? The cash price. Then after determining the cash price, from there you can determine what? The hire purchase interest. You are to determine the hire purchase interest. Then after that, identify the date, the agreement, and pay special attention, the date of the agreement, the date of that agreement, know the date, and pay special attention to what? Deposit and what? Instrumental date. Most especially, on the date of the agreement is usually the date of what? In which one they are going to pay the initial deposit. The date that they enter into that agreement is usually the date that the initial deposit will be paid. So you need to pay special attention to what? To the date of agreement and what? The instrumental date. Then identify the deposit and instrumental amount paid. So all those amounts, you need to know them. Then determine the relevant year of assessment and the related basis period for each payment. Then identify and add all payments falling within the same period for each year of assessment. So you need to determine, because the payment is not going to be made once, you need to analyze it based on what? The basis period that fall within what? Each payment. You may have, if a particular taxpayer is going to be paying on a 6-month basis, that means that there's going to be 2 payments in a year. That 2 payments in a year is going to qualify for capital allowance only once at the end of the year, because capital allowance is available at the end of the useful life. So anyone that falls within the same year, when they are making payment, will be added together as a single payment. Then introduce each new payment as a new payment for what? For capital allowance claim. So when you are computing under what? Under hire purchase. That tenure that you are expected to retain is also expected to be retained at the end of what? At the end of the useful life of the asset. Then the tenure will be retained from where? From the final amount of what? Of the asset. So on what? For the purpose of what? Capital allowance claim. Then also, we are told to note only the principal portion of the payment is to be utilized in computation of hire. Yes, I said it earlier. Only the principal portion will be in computation of capital allowance, because the hire purchase interest is what? Is an allowable expenses. Only what? Only the cash price will be what? Will be available for what? For capital allowance claim. The hire purchase interest is treated as what? As an allowable deduction for tax purpose. It's allowable. The denominator used for computing annual allowance after the first tax year is progressively reduced by 1 every time there is a new installment. You know that when you are calculating your annual allowance, after the first year, when you want to calculate annual allowance in the second year, the number of years will not be the same again. This is also applicable to what? When asset is acquired on what? On hire purchase. So the number of years will keep falling until what? Until when you get to what? The end of the useful life. The 10 naira considered as nominal value per item is deducted only from the last installment. So the 10 naira will be deducted from the last installment when you are what? When you are computing what? Capital allowance, when asset is acquired on higher purchase. So take note that you can also be given questions that relate to computation of what? Asset acquired on what? Higher purchase. Any question? So let us look at a question to illustrate when asset is what is acquired on higher purchase. And how will you know that asset is acquired on higher purchase? You'll be told by the examiner that the asset was acquired on an higher purchase agreement. So in that, you need to apply the principle of higher purchase to the computation of capital allowance. Koshemani Limited acquired a motor vehicle with a higher purchase price of 300,000 naira. If you look at this one, they have given us the higher purchase price on 1/1/2014. The higher purchase interest rate is at the rate of 10%. The details include an initial deposit of 100,000. Balance was payable in 4 equal installments in 6 months interval with effect from the date of the agreement. You know, when I was explaining, I said pay attention to what? To the date of the agreement and the what? The date of what? Initial deposit, which is usually paid on the date of the agreement. The accounting date of the company is 30th June annually. All installments were paid as at when due. You are required to compute the capital allowance claimable up to the end of the asset life. Compute the capital allowance claimable up to the end of the asset life. When you have a question relating to what? To higher purchase, you have basically you'll be giving what? You'll be giving only one asset because you have to spread the asset depending on the number of period. So to now compute the capital allowance, so we have what? So let us go to the computation. So we have the name of the company as Koshemani Limited. Koshemani Limited. Computation of capital allowance for relevant year of assessment. Before I can be able to compute this capital allowance, I need my workings. So we are going to go to our workings. Workings. We need to analyze our working. The first working. Working 1. We need to know the various information given to us, the various dates available for the. So what is the accounting? We need to know the accounting date. What is the accounting date of this company? It's as at when? We are told that accounting date is what? 30th June. From the question, we are told that accounting date is 30th June annually. Accounting date is what? 36 annually. After the accounting day, so we also I need to get some information. I need to get information relating to what? To the higher purchase price. But this question, we have been given the higher purchase price straight away. So we are told from the question, if you look at the question, let me go back to the question. We are told that the higher purchase price is 300,000. The higher purchase interest rate is 10%. So we are giving the higher purchase price. So we need to determine what? Determination of cash price. So which will be what? The higher purchase price, which will be 300,000. Which should be 300,000. Which should be 300,000. Let higher purchase interest. We are told that interest is at the rate of 10%. So 10% of 300,000, that will give us what? 30,000. So let's 30,000. So the resulting figure will give us what? The cash price of 270,000. So it is this cash price now that will now be available for what? For capital allowance claim. So this cash price is what will be available for what? For capital allowance claim. So we have the cash price of 270,000. Out of this cash price, we need to know how much is the instrumental payment. How much is the instrumental payment and what are the stream of what? Of the instrumental payment. From this cash price, we need to know how much is what is the total installment. So determination of instrumental payments. How do we determine that? We have the cash price. From this cash price, we have the cash price of 270,000. You now say less initial deposit. From the question, how much is the initial deposit that we are told that this person is going to pay? How much is the initial deposit to be paid by this person? So let me go to the question. From the question, we are told that initial deposit of what? 100,000 naira is going to pay initial deposit of 100,000 naira. So if it's going to pay initial deposit of 100,000 naira, so 100,000 naira, 100,000 naira. So that means amount that is going to pay, total installments now, is total installments will be the cash price minus what? The initial deposit, which will be what? 170,000. So in all, the instrumental payment is going to pay is what? 170,000. So we need to get how much amount per installment. Amount per installment will now be equal to, I said that total is equal to total installments divided by number of installments. So that will give us amount per installment will give us 170,000 divided by, from the question we are told that all installments were paid as a so balance was payable in 4 equal installments. 4 installment, number of installment is 4 divided by 4. 4 equal instrumental payments. So that will be 170,000 divided by 4. So that will give us for each installment is going to be paying what? 42,500. 42,500 will be payable at each installment. So since we know that 42,500 will be payable at each installment, so the next thing for us is to what? So we now need what? Our date of acquisition. So working for, I need some dates. Date of acquisition. When did they acquire this asset? We are told that the Koshemani Limited acquired a motor vehicle on what? 1/1/2014. So 1/1/2014. It was acquired on 1st 2014. 2014. For a company that's having a year, look at it. Accounting date is what? June. For a company that is having look at it, date of installment. So we now need to work to analyze. We now have a working file. Analysis of instrumental payments. To know which year the installment is going to fall into. So to analyze the instrumental payment, we are going to analyze them in tabular form. Then we have the details. What are we analyzing? And after the details, we have instrumental date, amount. We have instrumental date. We have amount. After instrumental date, we have amount. We have basis period. We have basis period. Then we have total amount. Then we have year of assessment. So look at all this information. information we need to be able to analyze this instrumental date. Then I don't need the amount. Yeah, we have amount. We have basis period, total amount, year of assessment. Year of assessment. Oh yeah. So look at it. The agreement started on when? 1st of January. 1st January. The agreement started 1/1/2014. So the first thing he's going to pay is to pay what? Initial deposits. He's going to pay initial deposits. He's going to pay initial deposit. This initial deposit, I told you, is usually paid on the date of the agreement. It's going to be paid on the date of the agreement, which is what? 1/1/2014. How much is the initial deposit? You have initial deposit of what? 100,000 naira. 100,000 naira will be paid as what? As initial deposit. 100,000 naira. And after this payment, the next thing is going to pay what? First, they said he's going to pay in 4 installments. He's going to pay first installments. First installment will be paid, they said what? 6 months interval. 6 months interval. Will give us when? 6 months after 1/1/2014 will be when?
1/7/2014.
No, 36 months. 7 is what? The beginning of 7 months now. 6 months is what? 36, the end of June. So that will be what? 36/2014. How much is he going to pay? He's going to pay what? This what? This instrumental payment of what? 42,500. After that, he's going to settle a second installment. Second installment will be what? The next 6 months. What will be the next 6 months after 36/2014? Next 6 months after 36/2014 will be when?
31/12/2014.
Yeah, 31/12/2014. It's also going to pay what? The amount of what? The instrumental payment, 42,500. Then it's also going to settle third installment. Third installment, which will be what? It's going to settle that as at when? The next 6 months, which will be when? 20 what?
15.
Oh yeah, now 2015. It's going to pay what? 42,500. Then final installment, which will be 4th installment. Final installment will now be the next 6 months, which will be when? Oh yeah, now.
December 2015.
That's the 1/12/2015, which will be what? 42,500. So for each of these dates now, you need to get what? The basis period, that is what? For each of these days, you need to get the basis period. That if a company is having an accounting date of 30th June annually, and I want to get a date that is going to, this date, in line with their accounting date, this date that this instrumental date is going to fall into. Who can tell me what do you think will be the basis period that this date is going to fall into, in line with what the accounting date of the company of what 36 annually? I want to get a date, a basis period that this 1/1/2014 is going to fall into. That will be what? 1/7/2013 to 36/2014. Is that not so? If you look at this basis period now, you see that this date, 1/1/2014, is in this basis period of 12 months. I also need this date, 36/2014, It's the same thing. This basis period will still be applicable to this. Then I now need 31/12/2014. This basis period will, that will be what? 1/7/2014 to 36/2015, which will be for this basis period. I also need this date. That will be what? Also this basis period. Then I also need 31/12/2015. That will be what? 1/7/2015 to 36/2016. So for each of these dates now, you now look for anyone that is the same, anyone that is the same basis period. You are going to add the value together as what? As total amount. You can see that this basis period and this one is the same basis period. That means they are going to fall under the same year of assessment. Addition, these are the two amounts that is going to pay in that basis period. That the addition of the two will give us what? 142,500. That one will give us 142,500. Also, this one and this one will give us what? These are the same year basis period, 42,500 plus 42,500. So that will give us what? 85,000. Then we are left with what? The last one, which is what? So if I have a basis period that is ending 36/2014, who can tell me what is going to be the year of assessment?
2015.
A basis period that is ending 36/2014. What will be the year of assessment?
2015.
2015. Thank you. So 2015. A basis period that is ending 36/2015. What will be the year of assessment?
2016.
2016. A basis period that is ending 36/2016. What will be the year of assessment?
2017.
2017. So what that means is that what the asset will be, or capital allowance will now be available from where? From 2015 year of assessment, in line with the basis period. From this analysis now, you can now go to your computation of capital allowance. We have only one category of asset, which is what? Motor vehicle. So you write out the asset, motor vehicle. I told you for each asset, there is going to be what? Initial allowance. We have for initial allowance and annual allowance. So for this particular category of assets, their capital allowance is usually, we did this earlier, 50 and 25. So we have it as initial allowance is 50%. Initial allowance 50%. Annual allowance is what? 25%. So this annual, so this information you can now use it to compute your what? Your capital allowance. So you are going to start with what? The first year that you have in this basis period, which is what? 2015 year of assessment, based on what? Based on when it was acquired. So I have what? 2015 year of assessment, 2015. How much was allocated to 2015 from this our analysis? How much was allocated to 2015 year of assessment? How much? 142,500. 142,500. So 2015, we have what? Cost. You now say cost. 142,500. So for any new asset, as I told you, it's going to be available for what? Any new asset is going to be available for what? For initial allowance and annual allowance. So we have a total. So because you are bringing the new, we have an initial allowance. Initial allowance, that will be what? 50% of this amount. We give us the value for the initial allowance. Who is that? Okay. 50% of 142,500 times 50%. We give us what? The value of the initial allowance, which is what? Minus 71,250. We give us what? The initial allowance. So 71,250. Then we also calculate annual allowance. Annual allowance for this will be, to calculate annual allowance, our annual allowance working 5 is usually calculated as annual allowance in the first year is calculated as cost minus initial allowance over big N. So this will give us what? 142,500 This will be 142,500. 142,500 minus 71,250 divided by number of years. How many years? N. How many years are we going to claim capital allowance for this asset? 25%.
4
How
years.
many years is that? Yeah?
4 years.
It's not
3
3,
years.
it's 4 years. So
4 years. 4 years.
10 divided 100 divided by 25 will give us 4 years. So divided by 4. So 71,250 divided by 4 will give us 17. That will give us 17,813. 17,813. 17,813. 17,813. So annual allowance here will give us, will be what? Will be jacket. We put it in jacket minus 17,813. So you have 17,813. So now, so in 2015, you have a total capital allowance. So total capital allowance will be what? Addition of what? Of these two will give us total capital allowance. After 2015, you have 2016. 2016 will now be this minus this, which will give us a tax written down value. We have a tax written down value, which will be what? The value. So this minus this minus this will give us the tax written down 53,437. In 2015 year of assessment, from our computation, we also allocated 2016, sorry. In 2016, we also allocated another amount of how much? 85,000. So that new amount will be brought in new as what? As a cost. How much? 85,000. Please, for that new asset, it's going to be available for what? Initial allowance. Initial allowance will only be on this what? 85,000 naira. So that will be what? 50% of 85,000 naira will give us what? The initial allowance. So 85,000 naira times 50%. That will give us what? 42,500. Initial allowance is calculated on the cost. It's only available when what? The asset is brought in newly. So this will be what? This new cost will be what? Available for initial allowance. So which will be what? 42,500. We now have what? Annual allowance. So annual allowance will now be in two forms. So look at how you are going to look at it. Our annual allowance will now be annual allowance in 2020, in 2015, will now be, look at it, will now be, you know that in 20 written down value, we also have a new cost. The one for the tax written down value will now be tax written down value, which is what? How much is the tax written down value? 53,437. We have what? 53,437 divided by B, which is 4 minus before 20. Before this 2016, how many years on this asset? Small n. How many years? Before 2016, how many years have we claimed capital allowance on that asset?
Just one, just
Oh yeah,
2015.
now.
2 years.
2, okay, it's not, where do you get 2? It's only
So
1 year now.
Just one.
Now, 2015. We have only claimed it only in
Okay,
2015. It's only 1 year. So minus, which will be 4 minus 1. 4 minus 1. So we give us what? The value for the old. This will be annual allowance for the old. You calculate annual allowance for the old, which will be 53,437 divided by 3. So that will give us 17,812. Then you also calculate the annual allowance 2016 for the new. You also calculate annual allowance for the new asset, new. So for the new now, will now be cost minus initial allowance, which will still give us 42,500 divided by 3. You are going, please, because this asset is brought in new, it is still the same category of asset. The asset has started claiming capital allowance from where? From 2015. The fact that you are bringing this course newly is not going to be 4 years. It's still what? 3 years, which is what? 4 minus 3. So that will be 42,500 divided by 3. So we should be what? We should be 14,167. 14,167. So we add these two together to get what? The total annual allowance. So addition of that two will give us a annual allowance in that what? In that year of asset. Which is annual allowance will now be what? My jacket 31,979. So 31, which should be 31,979. So in 2016, you have a total capital allowance, which should be what? Which should be addition of these two will give us a total capital allowance. So which is what? Total capital allowance. After 2016, the next year will be 2017. 2017, you have a tax written down value. So tax written down value will now be, you add this one and add the positive minus the negative. So positive minus the negative. So we give us the tax written down value, which will be 63,958. In 2017, we have a new cost also. There's a new cost of 42,500. So that cost will be brought in new cost. We have 42,500 as a new cost. For any new cost, as I told you, it's going to be available for initial allowance. Initial allowance at the rate of 50%, 42,500 at 50% will give us 21,250. So which will be what? So you transfer it to the total column, 21,250 will be that. Then you also calculate annual allowance. The same way you calculated it. So we have what? Annual allowance in 2017. Annual allowance in this will now be 2017. For the old will now be tax written down value, which will be 63,958 divided by 4 minus. So before, how many years have we claimed annual allowance now?
Yes.
Who can tell us? Before 2017, how many years have we claimed annual allowance?
2 years, sir. 2 years.
Yeah, 2 years. 2 years. 2 years. Abi? 2 years. You have only claimed minus 2. So that will be 63,958 divided by 4 minus 2. That will give us 31,979. So that will give us 31,979 as the value. Then you also calculate the one for the new. In the case of the new, 2017 new, for 2017, for new, in 2017, you have what? Cost minus, which should give us 21,250. That will still give us 21,250 divided by 2. So 21,250 divided by 2. So that will give us 10,625. So you add up these two together to get what? To get the total annual allowance, which is what? Which is 42.
The should go to the electrician. Okay,
Yeah?
he's at home.
Hello, what happened? So that annual allowance will be what? Minus 42,604. So this one will be 42,604. So after that is for that. So in 2018, so you add up these two together to get what? The total. So this will give you total capital. This will give us total capital allowance. So in 2018 now, we have what? Tax written down value. So which will be what? Addition of these two minus this. So we give us the tax written down value. So which will be this plus this minus this minus this. We give us the tax written down value. So in that year of assessment. So which is what? 2018. So in 2018 year of assessment, you have also in 2018 now you go to your table. There is no new asset. You can see no new asset. No asset was acquired in 2018. So you now come here. So you say 2018. So that means the asset is going to be available for only what? Annual allowance. But if you look at this asset, you are supposed to claim capital allowance on this asset for how many years? For how many years based on the rates?
4 years.
4 years.
4 years. If you look at the year, you have a 2015 1, 2016 2, 2017 3. So that means this 2018 happened to be what? To be the fourth year. 2018 happened to be the fourth year. So, and I told you, at the end of the useful life, you are going to retain how much? How much do we retain?
10
as
naira
the
nominal value.
10 naira. So you retain what? 10 naira. So annual allowance at this year will be what? If you want to calculate it, you can calculate, but calculating it is what? Is of no use because it's going to be waste of time. So because the annual allowance is supposed to be this same amount. So let us calculate it here to be sure. So you have it as annual allowance in 2018 will be equal to tax written down value, which will be 42,604 divided by 4 minus, before 2018, he has claimed capital allowance for 1, 2, 3, minus 3. 4 minus 3, that is 1. So that will still give us for 42,604. It will give us for that same value. But according to the law, you are supposed to what? To retain 10 naira. You now minus 10 naira from this value. 42,604 minus 10 naira. So that will give us what? Minus 42,594 will now be the value. 42,594. So will now be the value forward for the capital allowance. So tax written down value. So will now give us 10 naira. So which is the value you are going to retain as the nominal value of the asset. That will be what? That will be the carrying amount. So because this 2018 happened to be the end of the useful life of this asset. So this is where your computation will end as far as this question is concerned. In relation to what? Capital allowance on what? When asset is acquired on what? Hire purchase. Any question? Any question? So you can also be given a scenario whereby what? It may not be direct. You may be given a scenario whereby the asset will be acquired on hire purchase. So let us take note of that. So any question? Any question? So that is what when you have what? A question relating to what? To capital allowance. So you can also have a scenario whereby it may not be only what? Only direct purchase, outright purchase. You may have a scenario whereby the asset is acquired on hire purchase. If it's also acquired, it's also available for capital allowance claim. So any question? So in the absence of no question, so this is where we are going to stop the class today. So I'm going to send the material, so the solution material to our group so that we can use that as the basis of our for our own knowledge. So thank you and have a lovely day ahead.